Welcome to vTalkInsight, Risk Sentiment Daily for February 12, 2026. Markets are wrestling with stronger U.S. data that delays Federal Reserve cuts, even as an AI and infrastructure boom keeps growth engines humming. Today we unpack how that tension is shaping risk appetite across equities, rates, commodities, and alternatives. Risk sentiment today looks balanced but nervous, with markets caught between resilient growth signals and a tougher policy backdrop. The S&P 500 rallied after the latest jobs report, but faded to finish essentially flat, while volatility in the high teens points to a two-way tape rather than a clean risk-on trend. On the growth side, January non-farm payrolls came in at around double expectations and the unemployment rate edged down, which reduces near-term recession fears and has helped small caps and cyclicals outperform. At the same time, that strength is pushing yields higher and has led markets to delay the timing of the first Fed cut from June to July, reinforcing a higher-for-longer rates narrative. Compared with earlier this week, when optimism around AI capex and easier policy set a more constructive tone, today feels more finely balanced. Structural growth stories in technology, energy transition, and commodities are still intact, but they now sit alongside labor revisions, consumer strain, and elevated cross-asset volatility that keep investors on edge and encourage more selective risk-taking rather than broad-based exuberance. Delayed Fed cuts and higher yields are one of the dominant bearish drivers today. A significant upside surprise in January payrolls, combined with stronger wage growth than expected, has triggered a sharp repricing of interest rate expectations and reduced the perceived likelihood of imminent easing. 2-year and 10-year Treasury yields moved higher by several basis points after the report, signaling that markets now see policy rates staying near current levels for longer. Across money markets and swaps, the first Fed cut has been pushed back from June to July, and recent Fed speakers have reinforced a message of patience, emphasizing that inflation remains above target and that they are in no rush to restart an easing cycle. This higher-for-longer backdrop weighs on long-duration assets and speculative areas such as cryptocurrencies, where weakness has persisted despite heavy buying by large holders. Long-dated treasuries have also become less reliable as equity hedges, pushing investors toward intermediate maturities and alternative diversifiers, while leaving equities more sensitive to any disappointment on growth or earnings as the discount rate remains elevated. Alongside the headline strength, labor, consumer, and stagflation risks are building beneath the surface. Benchmark revisions show that U.S. payrolls in recent years were far weaker than first reported, with large downward adjustments spread across many months and several periods of outright negative job growth even outside a formal recession. On the household side, softer retail sales, rising consumer loan delinquencies to near-decade highs, and earnings misses from discretionary names such as toy makers and brewers all point to mounting pressure on demand. These trends, combined with lingering inflation worries, have sparked talk of a stagflationary mix that could undermine risk assets and drive further changes in the shape of the yield curve. There are still offsets, including resilient spending among higher-income households and AI-driven investment that supports industrial activity, but the soft landing narrative now faces more questions. If upcoming payroll and inflation data confirm slowing momentum without a quick disinflation payoff, markets may need to reassess both earnings expectations and how many rate cuts are realistic later in the year. Elevated volatility and fragile risk appetite are another key headwind. Recent sessions have seen the S&P 500 swing from overbought to oversold conditions within days, while many participants openly acknowledge they are struggling to interpret price action, which raises the risk of sudden air pockets in liquidity. Currency and digital asset markets are amplifying this instability. The Japanese yen is rallying as carry trades are unwound. Cryptocurrencies such as Bitcoin and Ether have sharply underperformed equities despite accumulation by large holders, and gold has outpaced long-duration treasuries in recent equity drawdowns, with its market value now exceeding that of a broad slice of U.S. equities excluding the largest tech names. At the same time, gold is increasingly treated as a universal hedge against fiscal risks, equity concentration, and policy uncertainty, while the traditional equity bond hedge has become less reliable. With structural financialization of alternative assets and ongoing AI-driven sector rotations, cross-asset correlations are shifting, making portfolio construction more complex and reinforcing the premium on liquidity and diversification of hedging tools. On the bullish side, AI-driven capex and earnings support remain a powerful counterweight to macro worries. Major technology and cloud companies are in the midst of what looks like an 8 to 10-year infrastructure build-out, with an estimated majority of IT budgets now directed toward AI initiatives and data center investments. This spending is flowing into the real economy. Semiconductor leaders are reporting strong revenue growth. Industrial names such as turbine manufacturers are seeing record order books with a meaningful share tied to data center power needs, and hyperscalers are raising tens of billions of dollars in debt in a single day to fund these projects, with robust investor demand for that paper. Beyond infrastructure, AI is improving margins and productivity across sectors, from advertising to wealth management, where large firms have cut their costs to serve meaningfully without reducing headcount. Together, these dynamics support corporate earnings, add to U.S. growth, and reduce near-term recession probabilities, even though they also create dispersion by challenging legacy software and business models that are slow to adapt. Broader equity leadership and regional rotation are another constructive force. After years of concentration in a handful of mega-cap names, performance is now spreading to dividend growth, value, and smaller companies, while momentum as a factor is tilting away from high-beta speculation toward higher-quality balance sheets. Regionally, Asian equities have delivered double-digit gains year-to-date, outpacing other markets and signaling renewed risk appetite in that part of the world. In the U.S., the Russell 2000 has outperformed larger cap indices following the strong jobs data, consistent with a rotation into domestically focused cyclicals when growth appears more solid. Outside the U.S., shareholder payouts through dividends and buybacks are growing faster in Europe and emerging markets, adding a tangible fundamental catalyst to the case for diversification. With discretionary investor positioning only slightly above neutral, there is room for selective risk-taking as stock selection and regional tilts become more important than simply owning the index heavyweights. Commodities and emerging markets tailwinds round out the bullish drivers. In a more fragmented, multipolar world, commodity security has become strategic, benefiting resource-rich emerging markets and prompting initiatives such as a U.S.-led critical minerals reserve and a free trade club designed to support allied mining and refining. Policy moves are interacting with supply decisions on the ground. Authorities in Indonesia have ordered dramatic production cuts at a major nickel mine, sending futures sharply higher and underscoring how just-in-case stockpiling and supply discipline can generate both higher prices and more volatility across industrial metals. Currency trends are adding to these tailwinds, as a cyclical weakening of the U.S. dollar is expected later this year with eventual Fed cuts, while the yen has already strengthened on shifting rate and positioning dynamics. Together with rising shareholder payouts and stronger terms of trade, that backdrop supports the case for commodity-centric emerging markets, even though weak domestic demand in China and ongoing geopolitical frictions mean the path is unlikely to be smooth. Stepping back, today's risk backdrop is finely balanced. Stronger data and delayed Fed cuts are lifting yields and testing risk assets, while AI-driven investment, broader equity leadership, and structural support for commodities and emerging markets continue to underpin the longer-term growth story. Key signposts to watch now are the next rounds of labor and inflation data, Fed communication, and how volatility behaves around any surprises, as these will determine whether the current two-way trade resolves toward a renewed risk-on phase or a deeper de-risking. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.